Okay, let's jump right in. As I understand it from the notes, the core argument here is that the market is massively overlooking ONDS Holdings' true liquidity.
Massively. We're talking a pro forma $840 million after the Q3 report and that October capital raise.
And that, it fundamentally changes the whole investment thesis. It's not the speculative microcap anymore.
No, it's a well-capitalized defense player. That structural shift is the entire premise. And the central question, why is nobody talking about this cash, is really well-defined.
It is.
But for this to land with let's say, a professional investor, we need to maximize the shock value of that cash figure immediately.
Okay, so we're starting with the sheer magnitude. The material makes a strong case for that $840.4 million war chest. I mean, it highlights how it just eliminates near-term bankruptcy risk given the burn rate.
And that's absolutely necessary. You have to do that to shift the perception away from, a risky tech play.
Right.
But the central thesis that this cash pile is a massive under-discussed outlier, it could be made so much more potent right away by framing the magnitude in comparative terms.
Instead of just relying on the company's own history?
Exactly. Defining the anomaly against its own past is frankly insufficient. We need to define it against its peers.
I see. So the weakness, then, is that the analysis defines this cash anomaly internally, going from a tiny microcap to almost $1 billion in liquid assets.
Yeah.
But it doesn't immediately use those external comparisons to really convey the scale of this structural shift. That opportunity to just, shock a skeptical reader is kind of missed at the top.
It is. So my suggestion is to re-anchor that war chest comparison to direct defense or even high-growth tech competitors. That's how you demonstrate the uniqueness and the shift more aggressively.
You position ONDS not just against its past self, but against the present resources of companies it's trying to acquire or compete with.
Precisely. The market needs to see that.
That makes sense, in principle, but I wonder about the mechanics a bit. The analysis suggests calculating the cash-to-revenue ratio for ONDS, and then contrasting it with other defense contractors.
Right.
But doesn't relying on that confirmed $110 million plus 2026 guidance, that's 2 years out, doesn't that risk undermining credibility if the skeptic just sees that as speculative?
That's a totally valid concern, the reliance on projections. But the purpose here is about structural framing.
Okay.
By using the management-confirmed guidance for 2026, you are forcing the reader to view the cash in the context of the future entity ONDS wants to become.
Ah, a contractor that can pull in 9-figure revenues.
Yes. So the contrast isn't just a valuation exercise. It's a statement about proportional capitalization. If a future $110 million revenue company already has $840 million in cash, well, that ratio just screams strategic anomaly in a capital-intensive industry.
So using that future guidance isn't just for valuation, it's to aggressively set the stage for the strategic pivot. You're forcing the reader to see the company through the lens of its future self.
Exactly. Or think about an even more immediate shock factor. The intro could compare the $840 million in liquid assets to the entire market cap of a smaller competitor they're looking at for M&A.
Wow. Okay. That is powerful.
Isn't it?
If the analysis opens by stating the company holds, say, 4 times the market cap of a direct competitor just in cash, it immediately validates the whole argument. It moves from a speculative play to a strategic force before the reader can even get bogged down in the execution details.
It creates a structural justification for the entire report. Once the reader accepts that financial scale, they're suddenly much more open to considering the aggressive growth targets.
That's a really strong foundation. Okay, moving on to how that cash is actually supposed to be deployed. We should look at the section on strategic deployment.
The roll-up strategy.
Yeah, the material correctly identifies that ONDS is on this clear M&A spree. It's targeting complementary defense and drone tech. You have Centrix, Apiro Motion, 4M, Rift Dynamics, and then there's that $150 million unit for bridging Ukrainian tech.
And that entire 580% revenue growth target rests on integrating those targets successfully and quickly.
It does.
So to make this a truly robust, balanced analysis, the critique of that roll-up strategy needs to move beyond just generic execution risk. It has to grapple with the specific integration challenges in these, very diverse assets.
The analysis does have a standard bear case warning. It says, merging multiple acquired companies is difficult and often fails.
which is true for any M&A.
Right, but since the core thesis hinges on management deploying this cash to get massive growth, the risk assessment has to be specific to these targets.
And is there a risk that by just focusing on the general difficulty, the analysis is sort of overlooking the unique tech and cultural hurdles here?
You think so?
I think the execution risk needs to be bolstered by examining the complexity of integrating these varied platforms and, critically, their different operating environments.
Well, the acquisition list is extremely diverse. You've got established Western commercial drone tech right alongside assets that are, being developed via ONDS Capital, focusing on combat-proven Ukrainian tech. So if management is experienced in M&A, why is this specific integration so much harder than a typical roll-up?
Because the nature of these assets changes the fundamental hurdle. It's not just a business challenge anymore. It's a potential compliance and technological standardization crisis.
Okay, break that down. When you merge Western commercial drone tech, like a Rift Dynamics, with battle-tested foreign military tech, you're adding two major layers of risk.
Which are?
First, what I'd call a regulatory and logistical chasm. Integrating combat-proven tech into U.S. and NATO supply chains involves stringent compliance, export controls, security protocols, things that commercial M&A just doesn't touch. The bar is just completely different.
Completely. The standardization you need to sell to the DoD is vastly different from just integrating into a commercial network.
That makes a lot of sense. The material really should explicitly address whether that Ukrainian-sourced tech is going to need significant re-engineering or certification just to meet baseline NATO standards.
Yes.
Because then what looks like a quick tech bridge could turn into a really long, capital-intensive R&D project.
Precisely. And the second layer is technological standardization. The analysis needs to explore the difficulty of getting technological interoperability across these diverse assets. Are they porting combat-proven software onto Western hardware, or are they integrating foreign hardware into U.S. supply lines?
Each path has its own huge tangible hurdles.
Hurdles that define the execution risk way more clearly than just saying M&A is hard.
So by making the execution risk tangible, by focusing on meeting U.S. and NATO technical standards with these diverse global platforms, the analysis just achieves a much higher level of sophistication.
And the reader can then actually weigh the management team's ability to navigate those specific challenges, not just generic integration issues.
Right.
If you can show you understand the hardest path forward, the aggressive bullish outlook that comes later becomes much more credible.
That would significantly strengthen the risk section. Okay, let's move on to the third key area, how the analysis uses its most powerful structural defense, which is that sheer amount of cash per share.
The $2.20 metric. It's crucial.
The material explicitly calculates it at about $2.20, based on the 368 million share count. It creates a theoretical hard floor for the stock.
And maximizing the analysis's impact, especially for a retail audience, requires consistently leveraging that intrinsic value. That cash position acts as a foundational floor for the stock price. It's the ultimate weapon against dilution fears.
And the weakness is that this powerful metric, the cash floor price, is currently just, placed deep in the conclusions bull versus bear table.
It's buried.
It's totally buried. And since the whole point is shifting perception from a risky penny stock, burying this immediate valuation floor really limits its power to hook a skeptical investor early on.
We need to use this metric as a structural hook right away. My suggestion is to introduce the cash per share metric much, much earlier.
Where?
In the hidden balance sheet reality section, immediately after establishing that $840 million figure. Use it as an organizing principle to argue against the perception of high risk from the get-go.
But why move it to the opening? Isn't there a risk of focusing on valuation too early, before the business strategy is even laid out? Typically you introduce the potential first, then the valuation defense.
Normally, yes, but here you have to overcome a psychological barrier first. This is a stock that many investors see as having high dilution risk and a history of volatility.
So they'll filter everything through that lens of financial fragility.
Exactly. If you wait to reveal the $2.20 cash floor, they've already mentally dismissed the M&A spree as just too risky for a company with this market cap.
So by immediately stating that over $2 of the current stock price is covered by cash, you fundamentally change the starting context. The reader isn't analyzing a risky growth venture anymore.
No. They're analyzing a structurally supported strategic pivot. You are basically inoculating them against dilution fatigue.
It simplifies the whole assessment. You're saying you're buying a dollar amount of cash, and you're getting a defense roll-up strategy for free.
Or nearly free, yeah.
So one way to do it would be to restructure the opening.
You'd go directly from identifying the 840 million in cash to stating, with 368 million shares outstanding, this means the company holds roughly $2.20 in pure cash backing every share.
An unparalleled structural benefit from mitigating risk. That is the essential framing.
And then that floor value can be referenced throughout the analysis.
You have to. When discussing M&A costs, when addressing cash burn, when eliminating bankruptcy risk, it becomes this constant underlying theme that ensures the reader never forgets the structural defense that underpins the whole strategy.
That creates a much tighter, more impactful narrative, especially for an audience that's, predisposed to skepticism about these kinds of stories.
Absolutely. That constant reinforcement is how you defeat dilution fatigue and overcome the complexity of the roll-up. It simplifies the high-level assessment and provides a foundation for the deep dive.
Okay, so to summarize the three main actionable critiques here. First, we need to emphasize the comparative scale of that $840 million cash pile. Use external metrics against direct competitors to deliver that immediate shock factor.
Right. Second, deepen the analysis of the M&A execution risk. Move beyond the generic challenges and grapple specifically with the difficulties of integrating diverse technical platforms, especially that combat-proven Ukrainian tech, into really stringent US and NATO compliance structures.
And third, leverage the cash per share metric, that $2.20 hard floor. Get it in there much earlier in the analysis, use it as a structural hook, a persistent reference point, to immediately reframe the investment thesis from risky penny stock to a well-capitalized defense player.
You want to do that before any dilution fears can even take hold. Look, taking the time to challenge these assumptions, deepen the risk assessment, and focus on maximizing that structural impact will only strengthen what is already an excellent analysis.
We look forward to seeing how you strengthen the focus on the specific roll-up execution risk and reorient the significance of that $2.20 plus cash floor. Please send your